we've got our guest who's joining us this morning. Our guest is Oyinkansola Aregbesola. She's an investment research analyst with ARM Securities. And today we're talking about Nigerian Treasury bill spike at the last auction. Good morning, Oyikan, and welcome to Business Express.
Good morning to you too. Good morning, Lagos.
All right, let's get straight into it. Now, Treasury bills are, what we're talking about this morning. There's been a bit of a jump in interest rates for investors, and we're going to break it all down right now. Now, Oyinkansola, as we understand it, the Treasury bills are money market instruments that are quite different from the fixed income instruments. What is the difference, though?
Right. So, treasury bills are basically marketable money market securities used to raise money for the government, and basically they are short-term securities that mature in 1 year or lesser. Basically like the 91, there's a 3 month maturity date, there's a 6 month and a 1 year maturity. So basically they are purchased for a price that is less than their par value, which is called face value. And when they mature, the government would pay the holder the full par value. So essentially, their interest is the difference between the purchase price of the security and what you get at maturity. So this is typically different from the fixed income instrument, or better still, instrument like bonds, for example, that basically like an investment that provides like a return through fixed periodic interest payments and eventual return of principal at maturity. So that's where the difference lies. So basically, there's no interest payment per se, but then the interest that you get is basically you paying less, paying government a lesser amount and then getting more back at the maturity.
All right. Thank you, Oyinkan, for breaking that down. So still on this, I need to ask this though. Who actually carries out these auctions?
Okay, so the Central Bank of Nigeria conducts the treasury bills auction. I mean, and they are sold through a bi-weekly auction that is twice in a month. The CBN old auctions for these bills. It's quite different from the quite different from the bond instrument, which is basically issued by the Debt Management Office.
Okay, thanks for clarifying. We're speaking with Oyinkansola Aregbesola, and we're talking about this interest in this jump in these investments. Now, across the three tenors, 91 day, 182 day, 364 day, we actually saw about 1 trillion naira offered. Can you actually break down what an oversubscription is, particularly when it comes to that 364-day tenor?
Right. So, I mean, going back to yesterday's auction, I mean, we saw the 364-day bill oversubscribed by 3 times or 3.11 times. That is 3 times the offered amount was actually demanded by investors yesterday. So basically, oversubscription simply means that the demand for a particular instrument is higher than the offered amount. But oversubscription doesn't automatically translate to the CBN selling the amount demanded for by the investors. It just shows the level of demand in the market. What we rather witness is an allotment, which is referred to as sales, and the CBN can decide to allot less than the amount offered or equal, or offer higher amounts than it was offered. Using yesterday's auction, for example, again, the 364-day bill, the offered amount was 600 billion naira, while the subscription was 1.87 trillion naira, which is like an oversubscription of 3 times. And the CBN eventually sold 908.75 billion naira.
Hmm. All right. So for people who are actually looking to invest, we understand that this was a primary market option, but you can also buy at the secondary market. Could you possibly just break this down, explain the difference between both of these so that regular folk can have a grasp of what this really means?
All right. In the primary markets, treasury bills are auctioned at established rates, which basically determine the return to investors, like I explained earlier. So purchasing these instruments in the primary markets and then holding them until maturity will mean that the investors, get a fixed interest payment. Now, during the auction, bidders quote the discount rates they are willing to pay for each tenor of treasury bills. And after receiving the bids, the CBN would accept the lowest bids first and then climb higher until it has accepted the total amount it seeks to raise for the issued treasury bills. So this final rate is selected by the CBN as the maximum discount rate, also known as the stop rate. So any investor whose bid is lower or equal to the maximum rate is accepted, while quotes above the stop rate are outbid. So investors below the stop, and it is actually worthy to know that investors below the stop rates, get the rates that they bid for. For example, if I bid for a 364-day instrument for 10%, another investor bid for a 12% discount rate, and then the stop rate was at 13%, I would actually get my bid at 10%. And then the person that bidded for about 12% will also get a 12%. So the government sells these bills at the discount rate, which is lower than the face value, like I had explained earlier. So let me just illustrate with figures. So let's say that an investor decides to buy a treasury bill of 200,000 naira with a discount rate of 10%. It simply means that the investor will only pay 180,000 naira to the government, and will be paid the face value, which is 200,000 naira upon maturity of the instrument.
Okay. Now, the 91-day stop rate settled at about 17.24%. 182 was at 18, and the 364-day was at 19. And it does seem to be a huge jump from the rates prior to yesterday. So how can we interpret this rate increase? Is it possibly perhaps the CBN is being very aggressive with liquidity management?
All right. Okay, so before I go into that, I forgot to mention, I mean, for the secondary markets, when secondary market comes in when an investor does not, decide to hold to maturity and they will rather sell, in the secondary market. So basically, we can actually resell those treasury bills instruments in secondary market and, transfer the rights to receive the maturity, to receive the face value at maturity to another person. So basically, that can be, that particular transaction can be facilitated through a broker. So for the stop rate, I mean, yesterday's auction, I mean, it was indeed a big jump in rates. Basically, the Treasury bill auction yesterday was just as mind blowing as the AFCON match yesterday. So back to the auction, right? So stop rates went up. It actually went up to, for example, for the 91 debut, the
Mm.
stop rate rose by 12.24% to 17.24%, while for the 182 debut, the stop rate rose by 10.85% to 18%, while for the 364 debut, the rate rose by 7.46% to 19%. So one of the reasons why we're seeing the increase is of course, the deliberate attempt to manage liquidity glut in the system in order to curb inflation and also stabilize the exchange rates. And another reason why we're seeing rates this high is, of course, the investors' demand. If you recall, I mentioned that investors will actually bid for rates and bid for rates in the primary market. They'll determine the rates that they want to sell at. So basically, this is investors saying that inflation is, I mean, it's close to 30% already. So I would rather demand higher rates, for my investments to, close that negative real rate of return. So I mean, looking at the range yesterday for the auction, we saw that for the 91 day investors bid for rates between 7% to 17.24%. for the 182-day bill between 4% to 19.98%, and for the 364-day bill between 13% to 29.94%. I mean, that 29.94% is essentially higher than inflation. So it's not surprised there, seeing higher rates at the auction yesterday.
Okay. Now, at the next MPC meeting, it's expected that the benchmark rate of 18.75 will be increased again, because the CBN is obviously trying to rein in inflation. Now, if this happens, would we or should we expect the Treasury bills to keep going up, the rates?
Right. Okay. So basically, the monetary policy rate guides all other rates in the market, right? So, for instance, with an increased monetary policy rate, we expect banks to reprice their loans, for example. And in the same vein, investors in the treasury bills market would also demand higher rates, and this would reflect in their bid. So, also with the CBN trying to manage liquidity in the system by offering large amounts at the auction would also help increase rates, because when we have excess supply, it means that investors are actually in an advantageous position to demand for higher rates. So overall, we should expect to see rates to keep climbing.
Okay. What do you think would happen to the equities market, though, with the Treasury bill rates rising, particularly in this manner?
So because the returns in the treasury bills market are fixed, I mean, and then investors with low risk appetite tend to favor these investments, even though rates are typically lower than inflation rate at the moment. However, due to the increasing rates that we are seeing, in the markets now, we should expect to see some sell-offs in the equities market. Reason being that some investors would want to leave the equities market to, chase higher rates, which is basically like almost like a sure investment, because you already know that this is the amount that you're getting. But the equities market, there are a lot of factors that play into the equities market. The returns are not certain. So basically, would see some sell-offs in the market. But overall, market sentiment in the equities market will be mixed, because we're still in earnings period. We expect some excitement then when it comes to corporate release. So the equities market will be mixed, but then we should see some sell-offs in the equities market.
All right. In about 30 seconds, just for the benefit of our listeners, can you explain portfolio diversification?
Okay, so basically, portfolio diversification is basically you trying to diversify your investment across different assets. So it has many ways of combining assets, but at its root is the simple idea of spreading your portfolios in different several asset classes. So, and the reason being is the fact that it can actually help you mitigate risks and volatility in your portfolio, where potentially reducing, I would say that potentially reducing number of high DPs that you could
Hmm.
have. For example, if you put all your money in crypto, I mean, I don't think you can actually sleep well. So basically, portfolio diversification helps you to spread your risks across different asset class. And an example of such asset class could be that you put some of your money in equities, for example, put some of your money in treasury bills, put some of your money in bonds, you put some of your money in commercial papers of private companies, you invest in real estate, and so on. So that's basically portfolio diversification.
All right, that is fine. Thanks for explaining that. And that is it for Business Express. Thanks for listening, and special thanks to our guest as well, Oyinkansola Aregbesola, Investment Research Analyst with ARM Securities. Thank you and have a brilliant day ahead.
Thank you, and you too.
That's it for Business Express. Do stay with us. There's a lot more to come on the breakfast.